Um, Hi everyone. Welcome to uh, this time's edition of the series of continuous education events that's hosted by CFA Society Sri Lanka. Uh, the topic that we are going to discuss today is around the Sri Lankan stock exchange, the Colombo Stock Exchange, which has been in the news over the last few months. Um, if you are not if you have not been following the market closely, the month of January was a significant month for the Colombo Stock Exchange, with the all share price index recording the highest ever gain that the exchange itself has seen, the index itself has seen, as well as also becoming the best performing market in the world. Since then, we've seen a retracement of most of those gains in the month of February and through to mid March. And what we are going to discuss today with eminent panelists is, will Sri Lanka's markets bounce back, or was Super January a flash in the pan? Um, so before we start, I want to introduce you to our moderator and our panelists, after which I will hand over proceedings to our moderator. Uh, our moderator today is Nabiha Mohammed, CFA. She currently works as a manager at Colombo Port City in strategy and business development. Before her current role at the Port City, she has previously worked at John Keel's Holdings in corporate finance and strategy, and prior to that in private equity at Flatwell Capital, New York. So she will be our moderator for this evening. And we have three panelists today. Um, I'm happy to introduce all three of them to you, starting with Ms. Nilu Jayatilaka, who is the CEO and Director of SoftLogic Invest. SoftLogic Invest is the asset management arm of the SoftLogic Group. She's also the head of investments of the SoftLogic Group, one of the fastest growing listed conglomerates in Sri Lanka, uh, with vast exposure across healthcare, retail, ICT, financial services, automobile, and leisure. She comes with more than 25 years in the investment profession, uh, currently at SoftLogic Invest, and before that as the head of portfolio management at and director at Guardian Fund Management. So we are very happy to have her with us today. Then we also have Mr. Kanishka Pereira, who is a principal at NDB Zephyr Partners. Kanishka manages a private equity fund dedicated to investing in small and mid-sized businesses seeking growth capital in Sri Lanka. Prior to this role, he was the chief investment officer at Asia Securities Wealth Management. And before that, he started his career at Amber Research, which is now known as Equity Knowledge Partners. So we are happy to have Mr. Kanishka Pereira as well joining us this evening. And last but not least, we have Mr. Udishan Jonas, who is the chief strategist at CAL. And in his role, um, he overlooks the research and insights function of the group. Prior to his role as chief strategist and head of equity research, Udishan was a fund manager for CAL Investments, managing a portfolio of private wealth management mandates. So we are happy to have Mr. Udishan Jonas as well joining us this evening. So without much ado, I will hand over proceedings to our moderator, Sabiha, who will hopefully lead a wonderful conversation for the next an hour or a little more than an hour on this very interesting subject. Over to you, Nadia.
Hello, I'm extremely sorry. I think my mic was paused, muted, sorry. Thank you, Deshan, for the introductions. A very, very warm welcome to our panelists and audience joining us today. Today's topic will be focused on Sri Lanka's equity market, which turned around in January after a prolonged period to becoming the best performing stock market in the world. Let's first understand the fundamentals a bit and see how the corporate earnings have played out. I would like to present the first question to all our panelists joining us today. Let's start off with Kanishka. The Sri Lankan corporate earnings have seen a significant growth in certain counters, specifically in the tile, retail, and logistics sectors. We witnessed an investor favorite in Expo Lanka, which has shown amazing results. Is there a common denominator that has attributed to the growth? Is this sustainable, or should we be expecting a mean reversion? Over to you, Kanishka.
Yeah, Nabiha. So in terms of what's been happening with corporate earnings from a fundamental perspective, there are a few factors which have helped them. And to look at it, I mean, how we look at it is what's really short-term and what's really sustainable. One of the main things what we saw was the import restrictions, which helped domestic manufacturing, which may or may not last. And in addition to that, you had low interest rates coming into play, which made profitability that much easier to a large degree. But one few things that came out of this pandemic is there are some long-term sustainable things. I mean, it made corporates look very closely at their P&L and see what costs could they really be more efficient about. And the other side of the story about this manufacturing this import ban is that it allows the corporates to get a bit of a war chest, so to speak, to build up the manufacturing capabilities, which may give them economies of scale, which can help them drive growth going forward. But that is the more uncertain part of it. And whereas the cost savings that most of these guys would have done, that is something which we see as sustainable. And low interest rates, chances are it will continue at least for another couple of years, which will help until there is growth coming in from the banking sector, which will lead to low liquidity, but that's something we can cover later on. Other than that, I mean, specifically, I mean, one company that's what you mentioned, which has done phenomenally well was Expo Lanka. But what you need to keep in mind is that freight rates have increased substantially. I mean, something that used to be about $1,200, $1,300 pre-pandemic is now hovering around the $4,200 kind of level, which is helping them. And they have, from macro perspective, that's helped them. But from a company perspective, they seem to be using that cash to grow strategically as well, which is a smart idea without just dividending it out. So yeah, so I think some part of this is definitely sustainable over the long term. Some part may not continue throughout the short term. May end after the short term. Yeah.
Great. Thank you so much, Kanishka, for your comments. Nilu, would you like to shed some light in that area as well, please?
Yeah, so I think the whole thing is whether January was flash in the pan, right? So I think it's a kind of a exciting time for all capital market players because they are seeing one of the lowest levels in terms of interest rate. And the government, I think, is very committed to holding the rates at these levels. So it's kind of which asset class do you play? If interest rates are giving you a single digit return to investors, they are looking at an alternate asset class to earn money. So one was the equity market, which we saw lots of retail activity, and we saw it in daily turnover, right? I mean, I think in the history of the stock market, I have not seen daily turnover going every day on a 10 billion rupee minimum their 10 billion rupee turnover. Even with foreign investors, we would see one-off trade that happens and record such turnover levels. But here on average, there was like the turnovers improved. So it showed to everybody that there is money out there. And with all the money printing and with lower interest rates, there was lots of money chasing equities. So that's where we saw the valuations from being record low with COVID and the first wave where the markets tumbled. We slowly start with political stability coming after the elections and with a clear government mandate. There was like some people were waiting for a catalyst to come in to rejuvenate the market. And that's what I think happened in January, where COVID slowly eased off even with the second wave. It was very clear that they were not going to lock down the whole country. It was only localized lockdowns, which also brought in confidence to the people and to the investors that we are not going to face like a kind of April to June quarter, right, where the whole country was shut down. And the earnings started kicking in, where if you saw from quarter to quarter, earnings improved. And that's where it all took off in January. I don't think it's a flash in the pan. I think it's kind of a re-rating of the market that happened. But of course, the turnovers improved drastically. So mainly due to interest rates. That is the backbone of the whole thing.
Great. Thank you. Thank you so much for your thoughts on this. Udishan, would you like to share some comments on the corporate earnings growth that we witnessed?
Yes, in particular to corporate earnings. So if you look at the third quarter numbers, they came in at 30% higher year on year, and especially driven by sectors like transportation, where Export Lanka was the predominant company, and also in terms of companies, we saw construction-related material kind of picking up with the import substitution. So the local manufacturers were benefiting, plus with the difficulty in terms of opening LCs, even the ones which were allowed to be operated on a 180-day credit, saw a lot of problems in terms of bringing their goods down. So in addition to that, I think with the retail construction pickup that we saw with low interest rates, coupled with when people were staying at home, there was a pickup of repair activities at home. All that kind of fueled a bit of construction-related activity, which fueled that sector, the material sector in the market. In addition to that, there were certain sectors which benefited from the pandemic. We saw a surge in prices in terms of hand gloves, freight rates. Some of them might continue and might not. Say, for example, freight rates, if you look at the current rates from say Hong Kong to US, it runs at about $6.50 per kilogram, which was about $3 a year ago, right? So why this is happening is because your passenger flights, which were predominantly used as belly capacity for air cargo, is no more because of the travel restrictions and passenger flights not operating. So with that component not being there, there's been a capacity shortfall, which has resulted in the freight rates going up, right? So until the point where capacity gets back, or passenger flight capacity gets back on track, we will see a surge in terms of freight rates. Plus, in addition to that, with regards to the pandemic, we also saw retail consumption in terms of products like consumer durables, which saw a significant increase. So companies like Singer did very well. The reason behind it being there was a lot of requirement for work from home, for online schooling. So there was a lot of requirement for mobile phones, TVs, with people staying at home. All that kind of fueled the demand for retail. In addition to that, you have the export companies doing well. So that ripple effects of Haley's related companies doing well had an impact on overall earnings.
Great. Thank you so much for that. I think across the board, all three of you all mentioned import restrictions really fueling this corporate earnings growth. just to hit home a bit on the tile sector in particular, from the demand side, the small and medium scale contractors are facing severe pressures in terms of higher prices, and they're proposing the removal of the import restrictions. So what kind of an impact do you think we will have on earnings in the near term for these local producers if they don't really increase their productions in the midterm future? Would Kanishka like to answer this question, please?
I'll start off on it, and I think Udishan can definitely follow up on this because he covers the stock much closer than I do.
Sorry. Okay. Yeah.
So just to give my bird's eye view on this, what I would say is I think some manner of restriction easing will happen. I mean, that's kind of inevitable. But from my understanding, most of this tile consumption is from essentially from the end consumer, the retailer itself. Not necessarily from large-scale projects, which tend to get some kind of concession when they're getting those down. So, and from a retail perspective, I mean, it's not, it has gotten a little more expensive, that's for sure. But I don't think it's gotten to a level where it's unaffordable as such just yet.
Right. Thank you so much. So let's move on to the next question. The banking sector represents, is one of the largest sectors of the stock market, and it has underperformed the ASPI index for the last 1 year's performance, right? So its valuations in average with respect to price to book ratios is around 0.5. So I just want to put some emphasis on this sector and really understand if the industry is facing some uncertainties surrounding the moratoriums or NPLs, and are there any underlying concerns holding the sector back for investor confidence? Udishan, can you please take this question for me, please?
Sure. So in terms of banks, if you look at over the last 2 to 3 years, banks have been trading at a deep discount to their book values. Couple of reasons: we saw capital requirements by central bank being increased. We saw a debt moratorium cycle with impairments increasing, starting from 2018, where we went through a bad drought, which was followed by the Easter Sunday attacks, which had a bearing on the tourism sector, and which was followed by obviously the impact of COVID. So with the government giving in moratorium to delay payments on their settlements, we saw roughly about 35% of banks' loan book being classified as debt moratoriums where payments were delayed. And we will see majority of it or a large part of it starting to end by March 31st, 2021. Even though the impact of it is negligible compared to what we were initially expecting, there will definitely be an increase in terms of impairments that we could expect from the banking sector, particularly in segments like tourism, travel, retail, which have seen an impact in terms of their business activity. So there might be a scenario where the moratoriums might be extended. But apart from that, there are other reasons why the banking sector is taking a beating. One of them being that in terms of the banks are the proxy to the economy. So if the central bank is undertaking any action, monetary policy or anything of that sort, most of the impact is going to be felt through the banks. And for more assuation to whatever if central banks wants to control the economy, the main medium through which they will do it is the banking sector. Say, for example, with the heavy forex outflows that we saw, or in order to curtail the forex outflows in the last 2 months, we saw central bank coming and imposing a restriction on forward contracts. Right? So all of this has an impact on the banking sector. So especially with our fiscal position not being great, the debt repayment capacity having issues, and obviously banks having almost 2/3 of the maturing sovereign component, there is a lot of question whether banks will be affected. So this is the uncertainty that is prevailing, and the economic impacts will kind of trickle down into the banking sector. Right? Having said that, if you look at globally, the trend is shifting. So we saw a tech-driven rally last year, but now you're seeing a shift to value counters, where banks, financial utilities are the ones which are gaining in the last 2 months compared to the tech companies which were kind of leading the growth.
Great, thank you so much. That was very helpful. Anyone else would like to add any comments on this sector?
Yeah, just to add on to what Udishan said, I mean, the banking sector, being one of the largest sectors in Sri Lanka, got an impact because of Easter attack in 2019 and 2020 with COVID. So for 2 years, this sector has been underperforming the all share, right? But similarly, like if we are to look forward to 2021, I would say if we are seeing a turnaround in the economy, the first sector to pick up would be the banking sector as well, I believe, because always they are the ones who start lending, and when private sector credit growth starts, and which we predict to be at least about 9 to 10% in 2021, they would be the beneficiaries of the economic turnaround. Of course, then they have to manage, even the interest rates have come down, their NIMs have come down, right? So their margins have. But if we see a trend where the interest rates will pick up at least about 200 basis points, there will be a NIM improvement happening, and that too the banks would benefit. So I would say they kind of lead the index than be like passive in their performance.
Great, thank you so much. That was very insightful. Let's move on to the next question. So March 2020 witnessed an 18% decline month on month prior to the market closing for a 7-week period. So the global markets in general saw huge declines as well due to COVID-19 pandemic. Upon reopening, the index dropped a further 324 points, closing at 4,248, which was the lowest in the past entire decade. So did the prolonged market closure, exasperate the selling pressures? And did this have an effect on foreign investor confidence? Kanishka, would you like to take a grab at this, please?
Yeah, sure. I mean, I had first-hand experience managing in this shutdown.
Great.
So I think what I can add there is, I mean, obviously there was a bit of a confidence hit for sure. I mean, when the market is closed and only us and Bangladesh were closed at that point. But in a rather, I don't know, very odd manner, the lengthy shutdown results in most of the foreigners exiting some of their other positions in other countries which were open. So the pressure which came down to us was not as bad as people would have expected. So in a rather perverse way, the lengthy lockdown helped to a degree, but obviously I think afterwards the exchange had to do a fair bit of damage control in ensuring and delivering the message that the market won't be closed again. And the follow-on lockdowns, I mean, helped reiterate that. So I think we are past that point now. It did spook, to answer the short answer is it did spook foreign investors to a degree, but I think now we're past that point right now.
Great, thank you, Kanishka. Yeah, so from the lows, let's just move on to talking about the highs and how the Colombo stock market recouped its losses and became the best performing stock market in the world. So we had a phenomenal January 2021 where the ASPI gained nearly 30% month on month and closed at all-time highs of 8,812 as of 27 January 2021. So what really sparked this rally and what proportion was local, institutional and retail interest, or was there a new segment that joined the market? So this was also the month that ironically witnessed a very large outflows of approximately 12 billion rupees in foreign sales. Maybe you can touch on this as well. Anyone in particular would like to, Udishan, would you please answer this question? Would you be able to shed some light?
Yes. So in terms of, we went through a bad cycle starting from March. Markets took a tumble with the expectation of economic growth slowing down, unemployment increasing, businesses shutting down. So all that was felt in terms of the market decrease from 5,900 levels to 4,200. But in terms of the savior of the market was the liquidity infusion that came into the market. So not only was it for Sri Lanka, but globally we've seen about 12 trillion rupees of $12 trillion of central bank printing or monetary infusion, which has come in and created excess liquidity in the system. With the excess liquidity, we saw interest rates lowering to lower single digits, even not covering up for inflation rates at 4-5%, which kind of forced investors to look at equity as an option. So one obvious reason was the low interest rate. Second is that markets are always forward-looking, right? So what happened during the month of December, January was that the market was looking at a scenario of economic recovery starting to happen with the vaccine coming into play and economies opening up. So the rally, which was in December and January, was predominantly on the forward-looking or markets taking a forward view on potential economic recovery, on which we saw the retailers kind of coming in. So if you look at local participation was about 90% of the market in the fourth quarter. And it was more or less with the market starting to go up, retail investors felt the phenomenon of FOMO, fear of missing out. So they also jumped on the bandwagon, which kind of took the market to an unprecedented high during the month of January.
Great. Do you think the debt overhang issue, which had caused a downgrade in the sovereign rating narrative, played a role to exacerbate this issue as well? Kanishka, would you like to shed some thought on this, please?
Yeah, I'll just add a few thoughts on this 12 billion, roughly that's outflow in January. I mean, you saw the market hitting quite a high level, about 8,800. So any foreigner who was focused on getting out of the market took the opportunity, because anyone could see at that point, we will have to depreciate the currency to large degree. I mean, why would you hold on to your positions when you got a price better than what you would have expected, and take a currency hit on it? So with that, I think that's one of the predominant reasons as to why you saw such a huge net outflow in that market. I mean, we are managing with the import restrictions and the swaps that we are getting, but ultimately, until there is a more sustainable solution there, I honestly don't think foreign investors will start allocating Sri Lanka, especially since there are other markets they can go to as well. Maybe if the currency depreciates about 10-15% or something like that, I think then you will see a substantial inflow coming in. But until then, it's unlikely. I think Udishan should have a few good thoughts on this.
You mentioned the swap, Nilu. Do you mind sharing with us today the new news, good news, I should say, on the 1 billion swap facility that the government of Sri Lanka has secured? Will it help drive foreign investor confidence?
Well, resorting to swaps is a short-term measure. So it's now going to bringing a lot of confidence for foreign portfolio managers, because what they want is structural reform and long-term solution to the debt problem. Because debt year on year for the next 5 years, Sri Lanka is going to see kind of $4 billion repayments coming. So the swap is a very short-term measure to address the problem in hand. So that's now going to bring the foreign investors into at least to get the portfolio fund managers investing. So they feel that we cannot go into international markets given the current ISB rates, international sovereign bond rates, that we can go and borrow on commercial terms. So our governments would have to, economic fundamentals are what are going out of the window kind of. So they are cautious about it. So we will not see, I do not foresee foreign fund managers looking at Sri Lanka given the current economic fundamentals. But saying that, when emerging markets do get money, they would look at Sri Lankan valuations, because sometimes they stock pick not on a macro level where they invest. So there could be particular stocks that we would see foreign buying coming, but not on a generic index basis where we would see foreign money. So that's the difference. But yeah, like I said earlier, I don't see huge foreign play in the market given the economic fundamentals.
Kanishka, do you have any thoughts? Sorry, Dishan, would you have any thoughts on the $1.5 billion swap facility and what kind of an effect that might have on the equity markets?
So in terms of the $1.5 billion, I think the market was expecting, as I mentioned before, market is always forward looking. So even in March, April, the market fell in anticipation of what's going to happen in the future. Similarly, the market was anticipating this $1.5 billion coming in, and with the progress made on port city legislations and so on, the market was actively betting on it, which is why we saw when the announcement came in, the kind of the movement in terms of market was not as much as what you would have expected to be. So the good thing about the swap is that it kind of gives us a 1 year kind of horizon to kind of restructure our debt position and so on, given that we can manage our sovereign bond settlements in July, which is about $1 billion, which kinds of puts us in a better position until we can kind of restructure ourselves when tourism gets back on track, bring the foreign earnings back again. So it gives us that cushion, or in terms of time frame, a period to which we could kind of hold on to. But having said that, the foreign outflows, one part is obviously the Sri Lankan equation, but the second part of it is overall the trends that we are seeing. So with the recent movement in US Treasury yields, especially on the 10-year, which is now, I think, gone to about 1.8%, about 60-70 basis points higher than what it was a couple of months ago, we are seeing an improvement in terms of yields to the US market, which is where the funds are flowing back to the US market. So from October onwards, we saw a lot of money flowing towards the emerging and frontier markets, which kind of reversed in the month of February or so. So if you look at the inflows to the emerging markets, it was only about $8.3 billion into equities in particular. That was the lowest point that we saw from October. So the high yields in anticipation of reflation in the US, there has been a slowdown in terms of funds coming towards the emerging and frontier market space. So as Nilu correctly mentioned, it's not an overall market view where funds will just flow into Sri Lanka, but for specific companies, if there is some strategic benefit for them in terms of that particular company benefiting or so on, we might see pockets of investments coming into Sri Lanka. But overall, it's not a market call as where they just have an allocation towards the frontier or Sri Lankan market as such.
Great. Thank you. Kanishka, would you mind sharing some thoughts as well, please, on this $1.5 billion facility?
Look, I think, I'm agreeing with what the other two panelists are saying on this. It's pretty much, how would I put it, a band-aid. It's not a long-term solution to our problems that we have. But having said that, it's not that we have many other options to go with at the moment. So in terms of a band-aid, it's the best band-aid that we got. And it's expected, right? Just expected. So that's why, as Sudhishan was mentioning earlier, market barely reacted to it. If anything, the sovereign bond market reacted much better than equity markets, because for them, the risk of default is a more realistic near-term thing, whereas in equity markets, it's not that much of a issue at the moment with this swap.
Absolutely. Yeah, thank you so much for all your thoughts. I would like to invite the audience as well to please send in your questions to our chat box, and happy to send it across to the panelists. Yeah, so let's move on. Let's talk about the all-time post intraday highs that we saw in January, latter part of January, where it reached 9,000, approximately 9,000 points. And then after that, the index shed another 1,550 points in February. And thereafter, we've seen a further decline, wiping out those gains. And as of today, we've closed at 7,160 points. So do you think the index has bottomed? And how does the Sri Lankan market valuation stack up with our regional peers? Nilu, would you like to answer this question, please?
Yeah, I will answer it in a different way, right? I mean, what I would look as a fund manager is, okay, what's our global rating, right? If we are a triple C category country, if I'm a global fund manager, I would be looking at, okay, similar countries with similar ratings, right? So Sri Lanka currently has a triple C rating. So Pakistan, who is like, let's say, closest to our rating, draws a price to earnings ratio of like, let's say, 7 times, whereas we would see on a forward earnings 11 times. Let's say, assume that we are going to have like, we forecast that we would have like about a 35% earnings growth this year. So we would be trading at a forward multiple of 11 to 12 times. So when you see relative to other countries, right, similar ratings, then we are overvalued. That is, I would say, to a foreign fund manager having a global view and having a global opportunity to invest anywhere in the world. But let's take you as a Sri Lankan. Where do we have to invest? So for me, as a fund manager, I would say 11 times and having a market earnings growth of 33%, I could stock pick and get a better return than the fixed income asset class. So that's the way I would look at it. Sometimes people would justify and say, okay, is it Sri Lanka? Is it expensive? Is it like, is it overvalued now? All these things. For me, simply I would look in terms of what is my return in an alternate class to what I can get in terms of equity, and holding it, let's say, for more than 12 months, what would give me the return. So there are two perspectives that you have to really look at, on a global fund manager's perspective and a Sri Lankan investor perspective.
Can't hear you, Nabiha.
Thank you. Sorry about that. Udishan, do you mind sharing some comments on this question as well, please, in terms of Sri Lankan market valuations and how it stacks up with regional peers?
Yeah, so in terms of valuations, yes, the market went up significantly in the 2 months. But keep in mind that in a bull market, we've seen during 2010, 11, 15, 14, 15, market multiples were even as high as 23 times. Even if you assume the January or the March and June quarter earnings reverting back to what it was in 2020, the multiple will be at about 9 times. So yes, I agree, compared to countries like Pakistan, yes, we are relatively on the higher side. But if you look at the emerging markets, they have shot up drastically. So you can see countries like India now trading at about 30 times earnings, similar to the Southeast Asian countries. So in terms of comparative multiples, I would think Sri Lanka is still okay. But if you compare the macro problems that we have, that might have put a backfooting on foreign investors. But having said that, the issue in terms of what brought down the February numbers was, one was the credit curtailment, second was the West Container Terminal issue, where the bilateral relationship with India and Sri Lanka, with that kind of easing out, there were a bit of questions whether these projects will come through, because the government was looking at a lot of foreign projects coming through. What happens to investor sentiment with that? Plus, we also saw the currency kind of starting to depreciate, especially with a commodity super cycle, with commodity prices starting to go up. So the global supply restrictions have started pushing up commodity prices, which is bad for the market. So that was another reason why we saw the market kind of coming down. But having said that, the money, because still when rates are at 4%, the money is still out there, liquidity is still out there, right? Part of it has gone into real estate. We've seen a slight uptick in terms of real estate activity, but majority of it is still sitting in people's savings accounts, right? So if you look at your CASA ratios of banks, the savings ratios of CASA ratios have crossed about 40% for the big banks. So this was probably about 30 to 35% last year. So money is just lying there, right? What it needs, the market needs right now is continuous positive sentiment in terms of news, government policy towards the right direction is what the market is needing at the moment. If that happens, yes, the money is out there, people don't have an option, they will come back to equities, right? But directionally, the sentiment matters, right? So from my view, short-term sentiment is what drives it, medium term is liquidity, and long-term is your earnings kind of, your fundamentals kind of directing your market towards it. So in the short term, I think sentiment is what we are lacking at the moment. And with the negative sentiment, we've seen retailers going out. So if you want to bring them back in, you need to give in confidence in the form of new policies, government taking the right decisions in terms of policies, bringing foreign investments in, making those easy, the port city legislations, deregulations, those should be are needed to get back the retailers back into the market.
Great, thank you so much. You spoke about sentiments. Kanishka, there was a lot of narrative around pump and dump. Is it warranted? Do you think this has impacted retail investors as witnessed by the rapid decline in our daily turnovers across the board?
Look, I'm going to avoid the pump and dump thing and address something that that the retailers actually would probably be worried about. I mean, what would have led to this rather muted market turnover right now? I mean, what you saw was, I mean, number one is that because of the low interest rate environment, I mean, you had people putting money into equity markets, which drove it up. I mean, obviously, and January you saw close to 28 or 29% growth in a period of a month. So at that point, I would say most people who were savvy about the market would have exited and now are sitting on some rather good gains, which they don't necessarily need to risk again. Now, keep in mind, these were all, I would say, most of this was fixed income investments, which your typical investor would look for a safe, non-volatile asset. They are now relatively quite happy with the return that they got. So chances are, if you were in the market from say November, December, you exited in January, I don't think those guys are likely to come back again unless market valuations come down substantially. The other issue, what I see is there was a huge amount of volatility. I mean, up 28% in 1 month, down 14% in the next. I mean, these are people's savings we're talking about. So that would have worried them. And that's probably why most of this is now sitting just in savings account right now. Investors are probably like, you know what, I'll just sit this out for now. I don't want to lose my capital unless there are some very compelling valuations or continuous positive sentiment that comes out. So that's those are my thoughts. I mean, one catalyst that I would look for is the March earnings cycle. I mean, if you see a continuation of the earnings growth or maybe a little bit better than what was seen in December, you might see money flowing back into markets. I mean, it's all about expectations, right? I mean, right now people are expecting good earnings, but now the market needs to show excellent earnings for money to come back into it.
Right. You mentioned volatility in the market. Are there any specific counters that are overly volatile, which has played to the uncertainty and where investors have burnt their fingers in particular?
Yeah, I mean, there would be quite a few of those, but stuff that would have gone up for all kinds of reasons. I mean, what we joke about at times is that maybe earnings for the next 10 years were discounted in already. So, so those kind of stocks, would have led to some investors getting burnt. I mean, that's for sure. And we saw this back in 2009-10 period as well, where investors got burnt and then they never came back for a long while.
Right. Udishan, would you have some comments on that as well, in terms of volatility in particular sectors?
Yes, in terms of volatility, I think a couple of the sector companies in the market also kind of came into the top 20 companies, with some of them actually benefiting from the pandemic. Some of them were retail driven, which kind of actually accelerated the volatility in the market as well. So in addition to that, the change in policies, things like that also kind of affected the volatility. And it's not only Sri Lanka that you're seeing this volatility. We're seeing this across all of the emerging markets, frontier markets, where the markets, if you look at the standard deviation of these markets, it's way higher compared to what they were before. So the negative volatility didn't really work well for the Sri Lankan retail investors who came in towards the latter part of the months of January and February, right? So with the negative volatility that they saw in the market, they kind of thought, okay, is it over? There's nothing new coming out. Are these expectations over? So with the kind of sentiment, they started pulling out the money. Plus, what we didn't see is the institutions coming and backing the outflows in terms of state institutions. Obviously, there was no foreign. Plus, the local institutions were not on the buying side, which is mostly because they're taking a wait and see approach in terms of policy direction and how things will pan out in terms of the government sorting out its structural issues. So until that point, you're going to see this negative volatility, which could be there. And keep in mind that investors always overreact. And when markets move up, they tend to buy more, keep on pushing prices. They don't adjust for the prices move up than what they should be moving for splits. So it's market overreaction. Similarly, when things start coming down, they act the same way, right? So which is why markets could fall more than what they should be, similar to what we saw during the March period, where during March we saw markets falling more than what they should have. So if there is a significant correction, though, I strongly believe that investors can come back, and that is particularly with the money just lying there without being parked anywhere. If there is an opportunity where they see where the market could re-rate back to where it is today, or slightly higher than what it was trading at, we might see the investors, retail investors also coming. But obviously, you need some backing in terms of announcement, support from earnings. Obviously, like what Kanishka said, it should be exceptional earnings rather than better earnings that we should see in the market. So that's what will drive the upturn in terms of the volatility.
Right. I mean, we touched a bit on splits here, right? So just to add on to this, we saw a frenzy of stock splits. Fundamentally, a stock split should not improve market value apart from providing additional liquidity to a counter. So the returns we saw due to the stock split, was it excessive? Udishan or Kanishka or Nilu, would you like to add some comments here, please?
So from my view, I think initially there was an overreaction to the splits, but if you look at the performance of those companies over time, they have kind of adjusted back to where they were, or there are slight gains in certain counters, but overall the alpha that you made by buying into companies which went through a split kind of deteriorated over time. So I don't believe that if you do more splits or anything of that sort, you will see an uprating in multiples as such as what we saw. Obviously, there should be an improvement slight improvement because there's more retail participation, a different set of plans coming in. But it doesn't necessarily warrant the 20-30% kind of increment in terms of returns.
Great. Thank you so much for all your comments. That was really helpful. So the international news around sovereign debt payments by international investment banks recently played a role in this continuous exit of foreign outflows. So talking about really market valuations in comparison to our regional players, and really how we stack up and trying to attract ourselves for foreign investors buying in. Is it fundamentally key for us to see an upgrade in our ratings? Is it all around that, basically? Nilu, would you like to touch on this, please?
Well, I think now the rating is like kind of people say we're triple C, whatever. But the main thing is whether the debt payment is sustainable. Because like I said earlier, it's not a one-off payment that we have this year. It's going to continue for the next 5 years. The $4 billion ISB payment. So if we don't get foreign direct investment, so what everybody is looking for in Sri Lanka to get some covenant is what kind of FDI will we have? What kind of maybe assets that can be sold to getting this kind of money into the kitty. So, or IMF kind of long-term funding line. So like the kind of factors that is behind everybody's mind in terms of ISB or for that matter in the debt payment that is coming up in 5 years. So yeah, so that's the backdrop that we are working on. So it's not really the rating. Now I don't think we have a chance of re-rating ourselves unless some huge structural changes happen, and then we are going to see a re-rating of Sri Lanka to a more higher category. But that's not what's in everybody's mind. It's this $4 billion year on year or lesser amount the government says is the key factor that everybody has questioning themselves, how are we going to do it? But I'm sure we are going to do it, but it's just the strategy to achieve that.
Absolutely, yeah. Kanishka, I would like to hear your thoughts as well on how we're tying up with the similar question that I asked Nilu with the debt rating and foreign inflows and the correlation.
So yes, Nilu said, I think, from triple C, coming back up from there, it's going to be a bit of a tough ask. I think the main thing is you need to have sustainable reserves going in there, and your debt to GDP numbers have to improve quite substantially before there's any upward re-rating on that, which in my opinion is unlikely to happen in the near term. So following on from that, I mean, in terms of equity markets, I mean, your typical frontier market equity investor is a little bit different to your usual investor. I mean, they're used to this risk, they're used to seeing instability, etc. So hopefully we will see a little bit more stability in terms of policy direction right now. I mean, one thing that worried us a little bit was, on the tile import, one day imports were allowed and then the next day it was banned again. I mean, so that kind of stuff is not something you would have expected. So that kind of stuff is a little worrying. And to a certain degree, it looks like there isn't too much of a game plan. Maybe there is, but it's not publicly available, which is a bit of a worry, I would say, that plays on equity investors right now.
Right. Thank you, Kanishka. We have a question from the audience directed at Udisha, leaning on the tile sector. I think the question is asking about the import restriction ban Can you add some thoughts to this, Udishan?
Yes, in terms of the import restrictions, I think with the heavy foreign outflows that or forex outflows that we saw, government kind of prioritized local manufacturing. And one argument why what the local manufacturers mentioned was, given that it's a small industry, you need economies of scale to kind of compete with the importers, particularly who bring down stuff from India and China. So what their view is that to achieve economies of scale, we need to give at least a couple of years time for them to kind of establish presence, increase in their base, and to enjoy those economies of scale. Having said that, this has obviously put exerted pressure on the price that the consumer pays. So we've seen roughly about a 50-20% increase in prices, and also in terms of a huge shortage in certain types of tile categories. So even recently, we saw a revision in terms of import duties, which were under discussion or which has not been gazetted, where they're talking about import duties increased and tile imports being allowed. But even though they are kind of looking at that as an option, the current forex position is not allowing them to kind of do that. So until we see forex inflows coming in back into the market, we won't see not only the market but the economy overall. We won't see the government to kind of increase allow imports to come back in. Even if it's allowed, it will be at a very high taxation. So it puts the local producer in a competitive position with the imports, but obviously the cost of the higher production is going to be borne by the consumer. From an overall perspective, your tile consumption for a typical housing project is roughly about 5 to 7%. So the impact is not significant as of now. So the consumer as of now is willing to pay the higher price. What is the problem right now is the shortage in particular areas where there are 2 to 3 month lineups for certain types of tile categories. So overall, there is an improvement in terms of supply, but certain tile categories, yes, there is a shortage that needs to be addressed.
I mean, these companies, these private companies are making excessive returns, right? So do you think, I mean, eventually they will actually lower their prices to help that end consumer buyer?
So in terms of pricing, so one stance that the local producers are taking is that they won't increase prices. They will maintain the current prices which are running right now. And that is the kind of guarantee they are asking from the government in terms of you allow us, you maintain the import controls for at least 2 to 3 years. We will put in the capex required to bring or expand the capacity, but we will ensure that there is no price increase during this period. So if that is allowed, I think obviously there is some kind of, because the material is sourced locally. So yes, there is some kind of advantage that the local manufacturers can also kind of benefit from. So from my sense, I think at least for a year, we'll see this import controls lasting for the tile sector. But for the local producers to kind of increase capacity, like the 4,000 square meters that they're planning to do, they will want a guarantee from the government saying that they need these controls to prevail for 2 to 3 years.
Great, thank you, Udeshan. Let's move on to the next question. Much awaited news. The Colombo Stock Exchange is finally seeing a large, highly anticipated IPO entering the market. This is a very bullish sign. Do you think this trend will continue? Kanishka, I would like to hear your thoughts on this.
Yeah, I mean, from a private equity investor point of view, I would love to see more and more IPOs because that helps us quite a lot in what we try to achieve as well. Look, I mean, it's always good to have more investment options available. There's something interesting, something new for investors to look at. And more than anything else, I mean, it helps us with one of the bigger issues that we've been having where the market is not necessarily a representation of the economy as a whole. So upcoming IPOs in different industries would definitely be quite welcome.
Nilu, I would love to hear your thoughts as well, please, on
Actually,
this.
for me, I think the private sector coming in is not what really the market needs. We need a big state institution, not a privatization, but a listing in terms will bring a lot of confidence in terms of even attracting foreign investors, foreign fund managers to look at Sri Lanka because they love these kind of IPOs. And if it's a state utility or something like that, a huge listing by a government entity would bring in that foreign interest back in the CSC. That's what I believe. Not in terms of private companies coming and listing. I mean, it's good. I mean, it's nice to see that these IPOs are happening. But what would really draw attention to Sri Lanka and CSC would be a state listing.
Yeah, I mean, are you suggesting privatization, or are you saying more, I mean, EPFs, ETFs should invest in the market in a bigger way? I mean, in a bigger way.
Not a state divestment, but maybe even a listing. Like, for example, Bank of Ceylon, listing of the bank for 10% stake, right? Would bring in that kind of market cap increase. That's what I mean by not selling off 10% of Bank of Ceylon. So that kind of like, state coming into the CSC would be like a positive factor for the market. That's what would really draw interest. And of course, these kind of IPOs that would come in terms of what is in the pipeline are very much local companies and would draw, but nice sectors, right? They are nice sectors, but you're not going to get huge fund managers coming and taking up these.
Udishan, do you think this is achievable? And how likely is this?
So I think with the hype built around the market movement, I think few companies have already planned for the IPOs. That process has already started. So we might see them coming up for IPOs in the next 3 to 6 months. This phenomenon is happening in India, Pakistan, Bangladesh right now. For example, India has 5 IPOs coming this week. I think Bangladesh has more than 10 IPOs which are planned, or Pakistan has more than 10 IPOs planned for. So that phenomenon is happening. The good thing is that if you were, and we are seeing an IPO after a very long time, right? And if you were listing in the market a couple of years ago, your market multiples were low. They were at 7 times at one point. So if you were to come to the market, you should have come at about 5-6 times earnings, right? Which doesn't make sense for a private company to kind of list in this kind of setup. Right? So with the improvement in market, the market multiples adjusting up, now the private companies can command a higher multiple than what they used to in the last couple of years. So that kind of puts them at an advantage where they could also kind of reap some kind of benefit from the upturn in terms of the market. So if market multiples remain at these kind of levels, yes, it makes sense for a lot of companies to start looking at IPOs as
well. So talking about this topic, Selendiva, a company named Selendiva was hoping to list, right? So any insights of success of this nature, really, and how this can really play out to attract those foreign investors as well? Any one of you, really, doesn't matter. That's fine. We can just move on. Okay. So I think across the board today, we spoke about fixed income rates. So fixed deposits are providing an all-time low yield, with yields remaining low for a longer period, as indicated or committed by the central bank. So what does this mean for investors looking for a return? Will the equity market become a permanent allocation for retail investors? And what are your predictions on the interest rates? Do you think there is space for 100 basis points increase? And if so, what is the sentiment for the equity market? Do you believe the investors are starved at this point to have that permanent allocation towards equities? Kanishka, would you like to take a grab at this, please?
Yeah, I mean, goes back to what I was saying about, why you had those fixed income investors coming into equity markets to a degree. I mean, in a nutshell, they were trying to catch up with whatever they would have lost from the low interest rate environment. Will it be a permanent allocation? I don't know, to be frank. I mean, for some people, it might be. With the upcoming policy clarity, they might have a permanent allocation to equities. But I would gather that most would be looking at, 15, 20% return and maybe exit the market at that point. Right. And, get themselves covered for that. That's my opinion.
Right. We have thank you, Kanishka. We have a question from the audience. Market performance aside, what do you think it will take for market participation to see the heights of January, i.e. 12 billion a day turnover? Is that level of participation healthy? Really open to any one of you all wants to take a shot at it.
So I think in terms of the 12 billion turnover, that included a lot of day trading which took place, and particularly people holding on stocks with the assumption that they could make a gain within a short span of time and kind of exit. So that, and when the market was moving up, you saw that happening where the same amount of pool of money was just flowing in from day to day on a day-to-day basis. But so this is something that you can't expect. So this is not sustainable to maintain a 12 billion kind of turnover. What I would feel is that to keep in participation, also keep in mind that a lot of it was credit fueled, which broker credit being cheap, and also the banking and finance companies providing cheap access to credit. This also kind of fueled that kind of growth. So a 12 billion market cap not much sustainable, but the current or what it was the last couple of years, about 600 million to 1 billion, is too low from my perspective. So I feel there should be an interim point or a median point in terms of market turnover, which is sustainable, which comes a lot from a mix of institutional, retail, and also state participation. So we haven't seen much state participation in this rally. It has been pretty low in terms of participation. So one backing that we would want to see is for the market to kind of maintain this kind of momentum. State participation should be there, given that foreigners are more likely going to be on the selling side. Can't hear you now.
Thank you, Udeshan. Finally, I would like to ask you all your predictions for a mid-year and end-of-year close to the market. And I would love to hear more about where you all think the interest rates, where do you think it would end at this year? And also a little bit on tourism arrivals to really boost our foreign reserves. And when do you expect foreigners to really re-enter the market? And also a little bit on tourism arrivals to really boost foreign reserves. And when do you expect foreigners to really... I think I think I lost you all there. Sorry, it's a bit shaky.
Yeah, I mean, in terms of targets for the market, I mean, where the SPA would be, So initially, I mean, if I were to go back to, say December, January kind of level when we were coming up with the numbers, estimates as to where the SPI would be, I mean, we thought, what, it'll hit 7,600 on a base case, maybe go to 8,000, and then it just shot up through those rather rapidly. So I think more than having a particular target in mind, I think what investors, what I would advise them is have an idea about what you would do if it hits those points. Say if it goes to 8,000 or breaks 8,000, what would you do? So you wouldn't be sitting there twiddling your thumbs, because as we saw, equity markets moved quite fast. So if you didn't have a game plan on what you do after 8,000, I think you would have probably lost a fair bit of your gains by now. So that's what I would say. I mean, it's quite difficult to come up with, where the market might go to, but what you should plan out for is something I think you should focus more on that than anything else.
Udishan, I would like to hear your thoughts as well.
Yeah. So the market movement will obviously depend on what kind of government policies also come into play, and the pace at which tourism kind of picks back up. So in terms of tourist arrivals, I'm pretty bullish that next year we might see a bit of pent-up demand coming in, especially with 2 years of no travel. It might not be 2021, but 2022, there is a very high probability, especially with our key markets, India, China, Europe, will be predominantly vaccinated by the end of the year, which might kind of start the next travel kind of cycle. And especially with the exchange rate, especially with the rupee kind of depreciating significantly against the sterling pound, the Indian rupee, we've seen about 8 to 10% against these currencies. And you can even price your properties relatively cheaper compared to your peer markets now. And Sri Lanka is obviously one of the travel destinations which will be vaccinated ahead of our peers. So this puts us in as a first move advantage, which we stand a very good chance to kind of benefit. And if that kind of happens, I strongly feel that could be the next market driver. And keeping in mind, tourism used to earn us $4.5 billion of inflows, which is actually a debt repayment that we're looking at. And also in terms of with deregulations in certain integrated resorts and things like that happening, if those are allowed, we might see that $4.5 billion taken to the next level in terms of tourism being a growth driver for forex earnings, GDP, and also kind of solving part of the fiscal problem. So from a government perspective, we need to bring in, if these policies come in terms of tourism, deregulating things like integrated resorts, this could be the next catalyst for the market. So if that happens, I think market could even look at 8,000, 9,000 in terms of points. But looking at the short-term phenomenon, I think the negative sentiment might continue for the short term, 1 to 3 months. If the policy direction is going to be, if the sentiment is going to be weak, turnover is drying up, right? But a lot will depend on how the legislation is changed from port city to integrated resorts. All that will be the game changer for tourism in particular, which could become the largest driver for Sri Lankan economy to kind of see that turnaround that we want to see.
Great. Thank you. Nilu, would you also like to give your final remarks on this?
On the interest rates, I would start on interest rates and then market expectations. On interest rates, on the short end of the yield curve, we expect it to go up like about 185 basis points from this point, because if you take the 12-month Treasury rate, it's currently moved up about 4 or 5 basis points last auction. So it's at around 5.10%. So we would see on the short end a movement of about 185 basis points, and on the long end of the yield curve, about 200 basis points. That's our forecast. Stemming from that, and inflation. Also, inflation to be around 5%. So actually, what is the real return you're earning? So based on that, I would say I would be more a kind of putting a higher weight to equity because the corporate earnings in the first quarter and the second quarter, when they see corporate earnings coming good, with local consumption, the banking sector coming in, which is a big sector this year, all that, the corporate earnings coming in at around 35% earnings growth, I would say the market re-rating should happen. And if I am an investor, I would be taking a long-term position, medium to long-term. Of course, there are market sentiment is low because people expectations of fast return. What people don't understand is that equity market is not a casino for them to make money. But if you're a fundamental long-term investor, I would say taking a position now in some select counters would give you a good return if you're taking a 2 to 3 year horizon. Because like we saw in May, when the market hit all-time low, see the return that people have got. Similarly, we would see the structural changes happening in the market when vaccinations fully, it's just the real sentiment of a certain segment of the population getting the vaccination has seen the mind change of the people in this country. I used to do yoga positions on Gall Road, right, during lockdown and all. Now when you see Gall Road, it's like buzzing. So the sentiment has changed, and that would carry through to corporate earnings, right? So in the short term, I think getting too negative would not be the case. There would be opportunities to buy certain stocks that would sustain their growth momentum. I think so stock picking would be the key. And I'm kind of more positive on the equities front because I feel when you see interest rates, inflation, all that, there would be a better return in terms of equity.
Fabulous, Nilu. Thank you so much for your comments and thoughts. We have a question from the audience. Any comments about the future REITs coming into the market? Really open to any one of you who want to answer this question.
Yeah, I'll add a couple of cents on there. I think it's a positive. As a fund manager, it's always good to have different investment options. It goes for any investor, I would say. But the challenge with REITs have always been what kind of yield do you earn on that? And we all know that yields on property is quite low unless there is some mechanism to capture in the capital appreciation. REITs will be a challenging investment. From my current understanding of how the REITs are getting structured right now.
Great, thank you so much. So we don't have any more questions from the audience at this point. So thank you so much for joining us today and answering all these burning questions about the stock market. It was a really engaging conversation and very happy to have you all over today. Deshan, over to you.
Thanks, Nabiha, and I echo what Nabiha said. Thank you to our panelists. It was very enlightening to listen to your thoughts. You were in agreement on most of the points. Some of where you all disagreed. I think it was a good discussion for our viewers also to take a view on. So thanks Nabiha, and thanks to our panelists Nilu, Kanishka, and Udeshan for your thoughts and accepting our invitation to be part of this panel discussion today. Thank you for all of you who joined in, and hope to see you at the next CE event. Thank you. Thanks everyone.
All right. Thanks for having us, guys. Thank you.